It's not you, it's us, says the G7 to the press. Were they just misunderstood when it comes to talk of currency wars? We'll get Vince Lance's thoughts up next. So the G7 put out a statement yesterday that seemed to signal concerns about excess moves in Japanese yen. The press picking up on this, but the G7 saying, no, we were misunderstood. Was it just a question of a bad relationship here? Oh, right before Valentine's Day, Vince Lance joins me on the line. Vince, thanks for being with me.
Thank you for having me.
Vince, let's start off by looking at that statement together so we can get Vince's take on it. So the G7 says, we, the G7 ministers and governors, reaffirm our long-standing commitment to market-determined exchange rates and to consult closely in regards to actions in foreign exchange markets. What's the word there that may have caused this misunderstanding?
The word "and" should be the word "but." The first half of that statement says, we believe in free markets. The second half of that statement, and what comes after that, says, but we reserve the right to do what we have to do to reduce volatility in the markets. Putting the word "and" in there instead of the word "but" is some English rhetorical attempt to hide your true intentions. And guess what? They couldn't hide it from the market. They weren't misinterpreted. The market read what it read and it reacted efficiently.
So it was just a question of bad PR on the G7's part?
It's a dysfunctional relationship between Japan's PR and the press. And I think the statement would be, it's not you, it's us, but we have to end this relationship. The bottom line here is, I think that statement said exactly the way it was 3 years ago would not have gotten the same reaction. The market is now taking the current Prime Minister, Shinzo Abe's statement seriously, and the world is getting ready for the currency war or currency crisis that's coming, and Japan is leading the way.
So Vince, let me ask you this. Obviously, the G7 was quick to stop rumors that they were alluding to a currency war. You obviously suspect otherwise and feel that Japan is in the lead in this race. My question to you is, how did they get in pole position?
Well, if you listen to hedge fund managers for the last 5 years, guys like you, Henry, and Kyle Bass, they've been calling for an inflation or a devaluation of the Japanese currency for years. And they're right, they're early, but there's nothing wrong with that. The bottom line is Japan has had lost decades of deflation, and no one has taken them seriously on their attempt to weaken their currency so they can sell more stuff overseas and get out of debt. But for some reason, and I'll just call it the market knows, the market looked at Shinzo Abe's statements. I'm going to target inflation. I'm going to print more money. I'm going to get us out of this recession, and took him seriously. And boom, Japan is the market that has been deflated for the longest in terms of its currency value, its currency and bond value. And now signs of inflation are here, and Japan's in the lead.
Vince, how does China fit into all of this?
Well, that's a good question. Historically, I don't know the percentage, but it's a large percentage. A lot of China's imports of finished goods came from Japan. So if Japan is a country that needs to, it's an island, right? So it needs to export itself out of a recession. So it needs to make stuff and it needs to sell them overseas, and a weaker currency helps that. However, recent tensions over islands and areas that China and Japan both claim as their own, that's not going to help China. That's not going to help Japan export their way out of a recession. So I wouldn't be banking on Japan selling its stuff to China to recover. So Japan's got some problems. They're going to have inflation without recovery, I believe.
Vince, just sticking to the topic of China, the Lunar New Year celebration happening this week, is that bad news for gold?
Historically, the New Year for China is a 15-day event roughly, and that is in and of itself a bearish comment on the market if you expect China to be a gold buyer. But to see the swoons we've had recently in gold, one would think that China is the only buyer. I walk away from this with three conclusions. One, China is a big buyer. Two, if they're not buying, or even if they're not perceived to be buying, it's pretty easy to push this market lower if you want it to go down. And three, China is so important for this market moving forward, and I do not underestimate their need to continue to buy when the new year's over.
Vince, were puts already put in place last week? How should you be playing it this week? Is it a good buying opportunity?
Well, on a short-term play, speculators last week bought the 1600 and 1625 puts in the March or April expiration area, as they did a month ago when gold fell out of bed as well. That's a good speculator's play. And the reason it's a good play is because if you believe you have a short-term event like China not buying, and you believe that the market will wash out, and you're not plugged in and you're just truly a naked speculator, and the market sells off, that also gives you the option to buy it when you think China is going to come back online. So it's a wonderful way to play a big dip in the market followed by a recovery rally. And that is the basis for my reason saying that number two, it's easy to get the market lower when China's not buying.
Vince, we're going to pull up the daily gold chart now, and I'd like everyone to pay attention to the widening gap between the two Bollinger Bands. Vince, does this signal a bearish case for gold?
Yeah, Bollinger Bands are used many different ways by many different technicians. We use them here, but not in a purely technical way. When the Bollinger Bands get to a reasonable historic tightness, as they are now, and then the market breaks out of them, as it has, and the top band and bottom band widen in opposite directions, you got to go with the trend. And that says that the market has a high likelihood of continuing lower. Now, if you were a trader and you were trading this, you'd be short now with your stop out at the 2 days ago settlement. It's also a good signal if you're a bull to say, hey, once it goes back in the Bollinger Band, I would be a buyer. But right now, I'd be cautious of buying dips. I would not be a buyer of dips.
Okay, Vince, let's end this edition with some fun facts. The world's top buyers of gold, the World Gold Council putting out this report earlier this week. So, third position, we find Turkey. Second position, China. Number one, who do you think it is, Vince? Drum roll, please.
Oh boy. Oh, I know this. We talked about it offline and I read this. The answer is Russia.
Excellent, Vince. That's correct. Russia, over the past decade, they've purchased 570 metric tons of gold. The amount is almost triple the weight of the American Statue of Liberty.
That's something I didn't know. Okay. All right.
Vince, are you surprised to see Russia in the lead?
The answer is surprised but not shocked. This all ties into the same thing. You know, whether you're a gold bug or an amateur who's interested in gold, the world is de-dollarizing. So what does Russia do? They make oil, they sell it, they take those dollars, they convert it to another currency. That currency, so far, for them has been gold. They want gold. They want to diversify their FX. What's Japan doing? They're selling the yen. What are they buying? Who knows? Could be dollars, it could be something else. What is China doing? Buying gold. Everyone is getting out of dollars. If I had to say one thing, Russia continually selling oil at these high prices and buying things like gold or a Chinese currency is a very significant long-term sign of the death of the petrodollar.
Vince, I just want to stress that just because Russia is having this gold rush still does not place them in the number one position of global gold holders. We still find the US followed by Germany. China and Russia are in 6th and 8th place, respectively.
No doubt, no doubt. The West has all the gold, and in terms of as a percentage of their FX, and China needs to buy more. When China gets all the gold it needs, then look out, because once it has a significant hedge against its own devaluation, it will weaken its own currency, and then you'll see rampant inflation.
Great conversation today, Vince. Finally, just tell us a key number for gold that you're eyeing.
They don't change. I'm sorry, they're so boring. 15 and a quarter on the downside and 18.20 on the upside. In between, we're in a big range. Last year, you may remember we talked about we're in a range of a range of a range.
Yes, that was my favorite tagline of last year. Thanks, Vince.
We're just now in the big range, and that's it. We're not going anywhere until we go somewhere.
Vince, thanks for your thoughts. We'll see you next week.
Thank you. Be happy to be here.
And thanks for watching this edition of Reset with Vince Lanci. You can email us any comments or questions at newsfeedback@kitco.com or follow this conversation at Daniela Cambone. Thanks for watching.